Good evening, dear friends. Good evening, all of you. I welcome you to this revisionary session today on financial management subject. And today we are going to revise the topic of capital structure, wherein we are going to cover both the capital structure theory as well as the capital structure problems. Okay. So let me first quickly recap the formulae or the concepts initially, and then we'll probably take up the questions to uh, cover up these things. Okay. So first up, uh, first part that we have is about selection of capital structure. Selection of capital structure. So when you say selection of capital structure, we are in the process of choosing one of the capital structure plans, right? So selection of capital structure plans. So if we have, let's say, plan 1, plan 2, and plan 3 to raise money, we have got equity share capital. We've got equity share capital. Let's say we're going to raise some amount of equity share capital. And the other instrument that we have is maybe the debentures. And the cost of debenture is, let's say, interest is, let's say, 9%. And one more instrument that we are issuing is preference share capital, in which dividend is going to be paid at the rate of 12%. Okay, so in the first plan, capital structure, let us say we have 10 lakh worth of equity share capital being issued, which is a fully equity plan. And the second plan is having like 4 lakh of equity and 6 lakh of debenture. Third plan is 3 lakh of equity. Then 4 lakh of debenture and 3 lakh of preference share. So total we have 10 lakh, 10 lakh and 10 lakh. Okay, so total we have 10 lakh in all the instruments or in the all the plans. And of course, I have to make a decision as to which one should we be selecting. So how do we choose? How do we make a choice of the plan? How do we make a choice of the plan? Which plan to choose, guys? How do we make a choice of the plan? Can I say for each of the plans, we calculate uh, the EPS, and if we have the P ratio given to us, we also calculate the NPS. So we start our discussion with EBIT, earnings before interest and tax. So EBIT is, let's say, 2 lakh in all three cases. EBIT is 2 lakh in all the three cases. From that, we are definitely going to subtract the interest, which will give us PBT. Further, we are going to, let's say, subtract the tax at the rate of 30%, which will give us PAT. Further, we subtract the preference dividend, which will give us net profit for equity shareholders. We're going to divide this by number of equity shares. Okay, let us say the number of equity shares, face value, if I take it as 10, it's going to be 1 lakh, 40,000 and 30,000. And when we're going to divide this, calculate the value of EPS, guys. Get the value of EPS. So for each of the three plans, tell me what's the value of EPS, guys. I'm waiting. Give me the value of EPS. Give the value of EPS. Can we calculate the EPS, guys? Can we do it? Everyone? Yes. Shagufta, Anil, Ranjit, Somesh, Kavya. Can we calculate the EPS? Yeah. Just calculate the EPS and let me know which plan are we going to choose. Per share equity. We have the number of equity shares, right? We have the number of equity shares given to you. So you just have to calculate these numbers and get the EPS value for all three of them. Give me the EPS plan. EPS for each of the plan. Okay, so first plan EPS is 1.4, guys. Just verify. First plan it is 1.4. Look for the other plans. Okay. Second one is at 2.55. Plan 2. It's 10.22 or 2.55. Third is 2.63. 3.36. I don't know. Numbers are quite different. So let me just do the calculations. So in first case, there is no interest, whereas in the second case, it's going to be 54,000 is the interest. In third case, it is 4 lakh into 9%, which is 36,000. So we have PBT of 2 lakh, 1 lakh 46,000, 1 lakh 64,000. Tax is at the rate of 30%. So on 2 lakh, we are having 30%, which is 60,000. So on 1 lakh 46,000, we have 30%. 43,800, 164,000 into 30%, which is 49,200. So PAT is 1 lakh 40,000, 1 lakh 46,000 minus 43,800. This is 1 lakh 2,200. 1 lakh 64,000 minus 49,200 is 1 lakh 14,800. Okay. Then preference dividend, of course, there's no preference dividend over here. It will be over here. So that's 36,000. Then we have the net profit for equity shareholders as 1 lakh 40, 1 lakh 2,200, and 1 lakh 14,800 minus 36,000. That's 1 second. There's some issue. 1 lakh. Yeah. So that will be what? 78,800. So now EPS is 1.4. This is 1 lakh 2,200 divided by 40,000, which is 2.56. And then it is 78,800 divided by 30,000, which is 2.63. Right, guys? So as per this particular aspect, which plan are we going to choose? Of course, we are going to go ahead with the third plan because of higher EPS. But what if I tell you that we have the P ratio available 10, 9, and 8.5? So what we calculate is market price per share or MPS. So MPS is 14. Then we have 2.56 into 9, which is 23.04. And then 2.63 into 8.5, which is 22.36. So of course, as per the MPS criteria, we should be choosing the second plan. As per the MPS criteria, we should be choosing the second plan. Got it, guys? So the market price per share is 23.04, which is that will be making us choose the plan 2, guys. Second plan. Okay. Fine. Now, if I ask you one more thing, let's say we want to calculate something called as financial break-even point. Financial break-even point. How do we calculate the financial break-even point, guys? Financial break-even point. Well, the financial break-even point is interest plus preference dividend upon 1 minus T. So over here, there is no interest, there is no preference dividend, and 1 minus 0.3. So break-even point is 0. Then the second thing it is interest is 54,000 plus preference dividend. Of course, it's not there. So break-even point is 54,000 itself. Okay. And then finally we have interest is 36,000 plus preference dividend is also 36,000 divided by 1 minus 0.3. So financial break-even point is going to be 36,000 divided by 0.7 plus 36,000. So that's 87,429. 87,429, right? That's okay. Now, there was some now financial break-even point. What was the understanding of this financial break-even point, guys? This was simply meaning that it is that level of EBIT at which EPS is going to be equal to zero, right? Then we have some concept called as indifference point, guys. Do we know what it is? What is indifference point? Anyone? Can anyone tell me what is indifference point? What is indifference point, guys? What is indifference point? Where the two level of EPS is equal. Perfect. So indifference point is that level of EBIT at which. So indifference point is essentially that level of EBIT at which EPS of two plants are equal. That level of EBIT at which EPS of two plants are going to be equal. So over here, let's say I want to know the indifference point between plant 2 and plant 3. So I'll have to first write down the equation of EPS of plant 2. How do I get the EPS of plant 2? It's going to be EBIT minus interest is 54,000. EBIT minus interest into 1 minus tax. There's no preference dividend subtracted. And then this is divided by the number of shares, which is 40,000. Then EPS of plant 3 Same way I'll write the equation as EBIT minus what was the interest? That was 36,000. EBIT minus 36,000 into 1 minus 0.3 minus the preference dividend. Preference dividend is 36,000. And then divided by number of equity shares, which is 30,000. So you have to just equate these two things. EPS of plan 2 and EPS of plan 3. Equate them and then solve it and give me the value of EBIT, guys. Whatever is the EBIT value that you're getting, that itself is your indifference point. Calculate the indifference point, guys. Calculate the value of EBIT, guys. We're solving it because whatever EBIT we get, that will be the indifference point. EBIT is 1,87,714.29. Is it? Anyone else got this answer? EBIT of 1,87,714. Just check, guys. Did we get this number? This is going to be 0.3 EBIT. If I solved it, 0.3 EBIT minus 54,000 into 0.3. 54,000 into 0.3. Sorry, it's 0.7 EBIT, my bad. This is 37,800 upon 40,000 is equal to 0.7 EBIT minus 36,000 into 0.7, which is 25,200 minus 36,000 divided by 30,000. So this gets cancelled and we have 0.7 EBIT minus 37,800 is equal to 0.7 EBIT minus 25,200 plus 36,000, which is 61,200 divided by 4 divided by 3. Let's just multiply it. 0.7 into 3, 2.1 EBIT minus 37,800 into 3, 1,13,400 is equal to 0.7 into 4. This is 2.8 times of EBIT minus 61,200 into 4, which is 2,44,800. Let's bring EBIT and other terms on one side. So we have 2,44,800 minus 113,400 is 2.8 EBIT minus 2.1 EBIT. So that's 0.7 EBIT. This is 1,31,400. So finally we get the EBIT value as 1,31,400 divided by 0.7, which is 187,714. Yeah, perfect. Got it correct. Okay, what is the significance of this EBIT number, guys? What's the significance of this EBIT number? It simply says that if your expected EBIT is less than the indifference point, if your expected EBIT is less than the indifference point, then you should be going for the less risky plan. And if it is more than, if your expected EBIT is more than this, then you should go for a higher risky plan. So 1,87,714 is the indifference point, and we observe that our EBIT is 2 lakh, which is over and above the indifference point. So of course, the higher risky plan was preferred as far as EPS criteria was concerned. Okay. So that was the discussion about the first part of the chapter, which is about the capital structure problems. Now, let us look at certain questions based on this capital structure. Okay. Yeah. Try out this question, guys. Question number 2. Ramu Limited wants to implement a project for which 25 lakhs is required. Following financing options are at hand. So equity shares is 25,000 shares of rupees 100 each. Second option is issuing 10,000 shares of rupees 100 each, 12% preference shares 5,000 at rupees 100 each, 10% debentures 10,000 at rupees 100 each. We want to calculate the indifference point and the EPS at that level of EVIT, assuming corporate tax rate to be 35%. So you have to get the indifference point between both the plans. Try it out, Race. Try to solve it quickly. Get the indifference point. Okay. Did we get it? Option B. Well, over here, the equation will be EBIT minus, there's no interest, rather just EBIT into 0.65 upon 25,000 will be equal to EBIT minus so 10 lakh 10%, which is minus 1 lakh into 0.65 minus preference dividend of 12%. So that's 60,000 divided by number of equity shares of 10,000. So when you solve this, is the answer B, guys? Is the answer B, guys? Is it option D, guys? Can anyone just confirm? I got one of the answers, but what about other participants? So this is 0.65 EBIT. In fact, we can further cancel it. 5 2s are 5 5s are. So upon 5 is equal to 0.65 EBIT minus 65,000 minus 60,000 divided by 2. So let's just multiply it. 1.3 EBIT is equal to 0.65 into 5. So that's 0.65 into 5, which is 3.25 EBIT minus 1,25,000. So we have EBIT on one side. So 3.25 minus 1.3, which is 3.25 minus 1.3, which is 1.95. 1.95 EBIT is equal to 1,25,000. So 1,25,000 divided by 1.95. That's coming out to be what? Something different. One second, there is some mistake. There seems to be some mistake. One second. So this is going to be 5 into, oh, sorry. This needs to be also multiplied by 5. So 1,25,000 into 5. This essentially becomes 6,25,000. So this is 6,25,000 divided by 1.95, which is 3,20,513. But there are two EPS, 8.33 and 12.82. So of course, you can simply take this EBIT of 3,20,512.83 or just 513 divided by 25,000. And of course, into 0.65, that's 8.33. So that's 8.33, right? So option B is correct. Correct option is B, guys. Did we get it, everyone? Yes, Nitravati. Sarang, Somesh, Kavya. Are you getting these answers? Option B. Yeah. Are you replying me here? Yeah. Can you explain this equation? See, the first plan, we took the EBIT into 1 minus T, which is tax rate. So that is 1 minus 35%, which will be 0.65 upon the number of shares. So this was EPS of first plan. And same way, this was for EPS of the second plan. So in second plan, you have EBIT. From that, you subtract the interest. Then you multiply it by 65% as the post-tax number, minus further 60,000 of preference dividend, and then divided by the number of shares. Right. So when you're doing this, we are getting the numbers as this divided by 5 and this divided by 2. So that gives us a EBIT value of 3,20,513. So we are simply equating both the EPS numbers. Okay. Are we good, everyone? Yeah. Okay. Let's go for the next question then, guys. Okay. Look at this question number 2A. Just read and let me know whether we can solve it. So, Jason, can we add in the starting of equation 1 lakh and 6 lakh? Why will you add 1 lakh and 6 lakh? What was there for 1 lakh and 6 lakh? 1 lakh and 60,000. Why? Why would you add that? So 1 lakh is interest and 60,000 is a. You cannot add it directly, Somesh, because there is a division. No? Number is getting divided by a certain number. So first need to get that sorted, and then you think of taking it to the other side. Okay. Now let's look at this question number 2A. Try out this question 2A, guys. So 2A should be able to solve it within what 12 minutes. Yeah. Yeah. I'll start again. Yeah. Try to solve it within 12 minutes. Let me begin with the solutions quickly. So we have the EBIT number. Now they're saying, the income statement is given. The company has resources surplus of 7 lakh and needs 4 lakh additional capital for expansion. There's no doubt, there's no change in the return on capital employed. You are informed that a debt, which is debt ratio, which is debt upon debt plus equity, if it is higher than 40%, that's going to push the P ratio down to 8 and raise the interest rate on additional borrowing debentures to 12%. You are required to ascertain the probable price of the share. If the additional funds are raised as debt and if the amount is raised by issuing equity shares at the ruling market price. Okay, so here we go. We have like three things to discuss. First is the existing thing, right? And then we have got one plan, we have got the other plan. We have existing wise, we have got equity share capital. So existing wise, we have got the equity share capital. So equity share capital is 30,000 equity shares of rupees 10 each. So share capital right now it is 3 lakh. And we have got reserves also, reserves to the tune of 7 lakh. Do we have some sort of debenture also? Yes. So we've got the debentures also in our business. So debentures at the rate of 10%, it is 40,000. So debenture amount is 4 lakh. So existing debentures that we have is amounting to 4 lakh. So total capital employed is basically 14 lakh and we need additional 4 lakh. Now these additional 4 lakh can be raised by way of equity or by way of debt. Now if you are going to issue, in first plan, if you're going to issue it by debentures, so this is the debentures which are paid interest at the rate of 10%. We will have additional debentures being issued at the rate of 12%. So the share capital 3 lakh, reserves 7 lakh, debentures 4 lakh of original one, that will remain same, and then we have additional debentures of 4 lakh. Right. And in the second plan, we're going to issue equity shares at the ruling price. So ruling price of equity shares, price to earnings ratio is given as 10. The ruling price is basically 40. Right. So in plan 2, number of shares issued will be 4 lakh divided by 40, which is 1 lakh. 4 lakh divided by 40, which is 1 lakh. So equity share capital is going to be, it's going to be 10,000, my bad. Yeah, so this will become 4 lakh because 3 lakh plus share capital of 1 lakh and rest 30 rupees is going to be carried into the reserve. So this will become 10 lakh. Rest, the original debentures of 4 lakh will continue. So we can see that total capital employed, it is 14 lakhs in both cases. So total capital employed is lakhs in both cases. And then we start with one more important thing to look over here is we have to look at the debt equity ratio, or I can say this is debt upon equity plus debt. So debt is 4 lakh upon equity plus debt is 14 lakh. So in fact, debt is over here 8 divided by 14. So 8 divided by 14, this works out to be how much? 8 divided by 14, that is 47.05%. And next is debentures are of 4 lakh divided by 14 lakh, which is 28.57%. This is 4 divided by 28.57. And they're saying if the debt equity ratio is higher than 40%, like in this case, then of course the cost of capital will be 12%. And the P ratio that will be applicable, it will go down to 8. Over here, the P ratio is still going to be 10. And then we start with the EBIT thing. You know, the existing EBIT, over here, the existing EBIT is 280. And 280 was earned on an investment of, sorry, my bad, 14 lakhs. And this is, guys, 18 lakhs. So this is 8 divided by 18. So 8 divided by 18, 8 divided by 18, this is 44.44%. And here it is 4 divided by 18. 4 divided by 18, which is 22.22%. So of course, here we are talking of the P ratio being equal to 8, and this will be P ratio of 10. Now, since our EBIT is 2,80,000, we would like to know what is the return on capital employed. What's the return on capital employed? So return on capital employed is 2,80,000 divided by 14 lakhs. 2,80,000 divided by 14 lakhs, which is 20%. So this 20% is going to continue as a return on capital employed even for the other plans. And then based on that, we will calculate the EBIT for the two plans. So EBIT over here is 20% of 18 lakhs, which is 3,60,000. Okay. And then from that, we subtract the interest, which gives us the PBT, less tax, which will give us the PAT. So the interest over here is two interest. One is on 10%, another is on 12%. So 10% is 40,000, 12% is 48,000. So that's actually 88,000 is the interest. And the second case, the interest is 10% of 4 lakh, which is just 40,000. Then we get a PBT of 3,60,000 minus 88,000, 2,72,000, then 3,60,000 minus 40,000, which is 3,20,000. Tax is going to be 2,72,000 into 30%, which is 81,600. 3,20,000 into 30%, which is 96,000. Tax is 30%, right, guys? Oh, sorry, 50%. Tax is 50%. So it is 2,72,000 divided by 2, which is 1,36,000. And this is, of course, 1,60,000. So PAT is 1,36,000 and 1,60,000. And then we divide it by number of equity shares. So what's the number of equity shares? In the first plan, the number of equity shares is continuing to be 30,000. And in the second plan, the number of equity shares is continuing to be becoming 40,000. So let us look at the EPS. EPS is 1,36,000 divided by 30,000, which is 4.533. And the second case is 3,60,000. No, sorry, 1,60,000 divided by 40,000, which is 4. Right? And then, of course, we know the P ratio over here, it is 8, it is 10. We'll look at the market price per share. So market price per share is 4.533 into 8, which is 36.27. And then it is 40. So of course, we are going to choose the second plan. We're going to select the second plan to raise money for the business. Okay. Got it? The second plan is going to be 40. So that's the highest MPS possible. So we go with the plan 2 for raising of funds. Did you get it, everyone? Yep. The second plan is going to be chosen. Over here, the most important part was to check the debt equity ratio and then finalize on the P ratio that's applicable. What's the reason for prioritizing MPS over EPS, Anil? Because um, the ultimate goal of the finance manager is maximization of shareholders' wealth. So the ultimate goal of finance manager objective is to uh, maximize the shareholders' wealth. Now, of course, shareholders' wealth will be maximized when you're having a option or when you're having a plan with the highest MPS. Are we clear? Okay, fine, great. So right now, just take a break, guys. 15 minutes, and after that, we'll begin with the next part of this chapter, wherein we are going to look at the capital structure theories, like your Modigliani-Miller net income, net operating income, all those theory part. Okay, so let's just take a break, guys. See you in 15 minutes. Okay, guys, welcome back. So, Shagufta is asking, can you explain how did you get debenture for 4 lakh? Well, you see the interest over here, 40,000. Interest is 40,000, right? And the interest rate is 10%. Of course, 40,000, if it is 10%, the principal of the debenture amount is definitely going to be, 4 lakh, right? Okay, so let us go for now the capital structure theory part. Certain basic concepts let's understand in capital structure theory. First, we know that value of equity is going to be calculated as profit after tax upon K, right? Value of debt will be interest upon KD. Value of firm will be simply EBIT upon KO, or we can also say that it is equal to value of equity plus value of debt. Okay, so value of equity and value of debt or value of firm is going to be calculated in this manner. We have certain approaches like net income approach, net operating income approach, model with the tax, right? And then arbitrage. Okay. So in net income approach, we say that as the weightage of debt increases, overall cost of capital reduces, right? And overall cost of capital reduces. As the weightage of debt increases, overall cost of capital increases. Overall cost of capital reduces. And as the overall cost of capital reduces, value of the firm is going to increase. So this was a theory of relevance, which stated that the value of the company is going to be affected by the amount of debt and equity. Then net operating income, it stated that value of debt increases will reduce your KO, but when the weightage of debt increases, your KE is also going to increase because of higher risk, right? And that will lead to KO also increasing. And the cumulative effect is that KO remains constant. So value of the firm will also remain constant, right? So no change in the value of the firm. Then in case of net income approach, we state that the value of levered firm is going to value higher than the value of unlevered firm. In case of net operating income, we have stated that value of levered firm will be equal to value of unlevered firm. Whereas when we have Modigliani Miller with the taxes approach, we said that the value of levered firm will be equal to value of unlevered plus debt into tax rate. So value of levered firm is equal to value of unlevered plus debt into tax rate. That's your model with the taxes. Okay. So model with the taxes is arrived in this way. And then arbitrage. Arbitrage, which was, investors were shifting from one company to another company depending on the rate of return that they were earning. Okay. So that's a net income, net operating income approach and model with taxes and without taxes or with arbitrage case. Now, again, let's just take up certain questions to look into this particular aspect. Okay, I'll do one thing. I'll just give a case to you. Let us say there are two companies, X and Y. Okay. Um, this is a unlevered company, whereas Y is a levered company. Okay. Of course, X doesn't have any debt since it is a unlevered. Y is having a debt of, let's say, 3 lakh. EBIT of both the firms, EBIT of both the firms is equal. Let us say it is 5 lakh. Or let me just take it as EBIT is 1 lakh. Tax rate applicable is 30% for both, and rate of interest. Of course, in case of unlevered, it is not applicable, whereas in case of levered, the rate of interest is 10%. Okay. We have the KO, or overall cost of capital, for X to be, let's say, 15%. KO is 15%. And here we don't know what is the KO. I want you to calculate the value of equity for both, value of firm for both, and also cost of equity for both the entities. Okay, just try to solve it, and for which we'll give you like around what, 10 minutes. Yeah, try to solve this, guys. Wait, one change, guys. Here we have this as K, and I want you to calculate KO for both. Okay, just try to solve this. Okay, guys. So we're able to get it. Okay, so we got the value of equity, value of firm for X. It is 6,66,667. But what about the others part? Well, let's try to solve it. We've got X and Y. We've got the EBIT. EBIT is 1 lakh. From EBIT, we are going to subtract the interest. So the interest is, of course, not applicable in case of X, but that's definitely applicable in case of Y. So in case of Y, the EBIT is, the interest is going to be 10% of 3 lakh. 10% of 3 lakh, that's 30,000. Then you get the PBT, approximately 1 lakh. And then they have this 70,000 less tax. The tax rate is what, 30%. So here we have this as 30,000 and 21,000. So we get a PAT of 70,000 and 49,000. So PAT of 70,000 and 49,000, that's your PAT. Now we can get the value of equity simply as PAT divided by K. So this is 70,000 divided by K is 15%. And for Y, it is as of now not possible. So we can definitely get this 70,000 divided by 15%, which is what? I don't know. What's this wrong? $70,000 divided by 15%, which is 4,66,667. That's the value of equity. We cannot say that with the value of equity for Y, but we know the value of debt is 0. So the value of the firm is going to be 4,66,667. Right? Now, what can we say about the value of Y? What can we say about the value of Y, guys? What can we say about the value of Y? Value of Y. Is the value of Y going to be same as value of X? No, it's not going to be the same. So rather, what I'll do is, since Y is a levered firm, I'll simply use the formula of value of levered firm is equal to value of unlevered plus debt into tax rate. So we have this as 4,66,667 plus the value of debt. How much is the value of debt? In case of Y, the debt is how much? 3 lakh. That's going to be 3 lakh into tax rate of 30%. So we get the value of the firm. So 4,66,667 plus 3 lakh into 0.3. That gives us the value of firm as what? 3 lakh into 0.3, which is 90,000 plus 4,66,667. This is 5 lakh 56,667. 5 lakh 56,667. That's the value of the firm. Now, of course, from this, you can subtract the value of debt, which is 3 lakh, right? That will give you the value of equity as 2,56,667. And then, of course, K will be PAT upon value of equity. So this will be 2,56,660. That's PAT was what, 49,000. So this is 49,000 divided by 256,667. So 49,000 divided by 256,667. So that works out to be what? 19.09%. Yeah, we got the answer as 19.09%. So 49,000 divided by 256,667, that's 19.09%. Okay, so K is 19.09%. We get it. So what we wanted is we got the value of equity, we got the value of firm and KO. Okay, so over here, KO. Remember the KO formula is normally it is EBIT upon value of firm, but since we have tax applicable over here, we can make it EBIT into 1 minus T upon value of firm. So the EBIT stands as what? 1 lakh. So the value of firm over here is going to be 1 lakh into 1 minus 0.3 upon the value of firm is 5,56,667. So that is 70,000 divided by 5,56,667. That's I think what, 12.57%. Okay, so these are the answers, guys. Just check. Did you get this? Did you get this, everyone? Yep. Yes. Perfect. Great. Let's look at some more questions then. Okay, let's look at this case then. Okay, so here we have the case and the 5 questions. Okay, so try to solve this, guys. And of course, I am going to give you a timer over here. Timer, you should be able to solve it within 15 minutes, guys, because it's 10 marker MCQ. Should be able to solve it within 15 minutes. Try to solve it, guys. Can we take PBT instead of PAT? No, we can't take PBT because when we have taxation applicable, it has to be PAT. Sure. Give it a try, guys. Solve this MCQ. I mean, the case that we have. We got it? Okay, so CBAAD. Anyway, so let's look at the solution for this. So first up, it's manufacturing minibuses. Since its establishment, it has seen a phenomenal growth in both market share and profitability. The financial statement of P&L and balance sheet are shown below. The company enjoys the confidence of its shareholders, who have been rewarded with growing dividends year after year. Last year, too, the company had announced 20% dividend, which was the highest in the automobile sector. The company has never defaulted. These all, is the story. Okay, the main part boils down over here that it wants to raise money of 3 crore 12 lakh 50,000, and there are three possible options: by issuing fully equity shares, by issuing partly equity shares and debentures, and by partly issuing equity shares and preference shares. So the company's earnings before interest and taxes after investment is 37 lakh 50,000. Income tax rate applicable to the company is 40%. Based on the above facts, the management of the company asked you to answer the following questions. So I want to compute the EPS of all the three plans in difference point between 1 and 2 and between 1 and 3. Okay. So let's try to solve this. Okay. Or let's just calculate with EBIT. Let's start with the EBIT calculations. Nothing great about it. So what's the EBIT that we are expecting? So earnings before interest and taxes, what, 37 lakh 50,000, and that's the same figure for all three plans. 37 lakh 50,000. From that, you're going to subtract the interest. So there's no interest over here. But in the second case, we're going to have an interest. So in second case, the interest is 1 crore 56 lakh 250 into 9%. So 14 lakh 6,250. Okay. So that's like 156,250. Face value is this into 9%. 14 lakh 6,250. There's no interest over here. So we get the profit before tax as 37 lakh 50,000. Then 37 lakh 50,000 minus 1406250. Mm-hmm. 06, which is 23,43,750, and this is 37 lakh 50,000 less tax. So 37 lakh 50,000 into, what is the tax rate? Tax rate is 40%, which is 15 lakhs. 23 lakh 43,750 into 40%, which is 9 lakh 37,500. And this is going to be 15 lakhs. So we get a PAT of 37 lakh 50,000 minus 15 lakhs. 22 lakh 50,000. 23 lakh 43,750 minus 9 lakh 37,500, which is 14 lakh 6,250. And this is also 22 lakh 50,000. Now from this PAT, we're going to subtract the preference dividend. So preference not applicable over here, but it's applicable in the last case, which is 15 lakh 62, 15 lakh 62 500. Yeah. So we get net profit for equity shareholders 22 lakh 50,000, 14 lakh 6,250, and then we have what, 22 lakh 50,000 minus 1,562,500, which is 6,87,500. Okay. Hmm. So we have this divided by number of equity shares. Over here it is 3,125,000. Here it is 15,62,500. And here also 15,62,500. So EPS is 22,50,000 divided by 3,12,005. That's 0.72. 14,06,250 divided by 15,62,500. That's 0.9. And then 687,500 divided by 15,62. That's 0.44. So of course, we got the first as 0.72, second it is 0.9, and third it is 0.44. Okay, then what's the EBIT, EPS indifference point between plan 1 and 2? So between plan 1 and 2, we can get it as EBIT minus, in fact, first plan there's no tax. So I can simply say that this is into 0.6 divided by the number of equity shares, which is 3,12,500, 31,25,000. That's equal to EBIT minus interest of 14,06,250. This into 0.6 divided by 1,562,500. Okay. Of course, we can cancel it and just write it as 2. So we have 0.6 EBIT is equal to 0.6 EBIT minus 1,406,250 into 0.6, which is 8,43,750 into 2. So that's 0.6 EBIT is equal to 1.2 EBIT minus 8,43,750 into 2, which is 16,87,500. So we have 16,87,500 is equal to 0.6 EBIT. So we have EBIT is equal to 16,87,500 divided by 0.6. So this is divided by 0.6. That is 28,12,500. That's option A, guys. Right? And then between 1 and 3, we have between 1 and 3, we're going to have a similar equation, but a bit of difference. This is going to be what? 0.6 EBIT upon 31,25,000 is equal to 0.6 EBIT minus preference dividend is what? 15,62,500 divided by the number of shares is 15,62,500. Again, we just take it as due. So we have 0.6 EBIT is equal to 1.2 EBIT minus 31,25,000. So we have 0.6 EBIT is equal to 31,25,000. So we get the EBIT number as 31,25,000 divided by 0.6. 31,25,000 divided by 0.6, which is 52,08,000 333. Option D. Right. So that brings this case study answer to an end. So with this, yes, we are through with the revision for the capital structure theory, guys. Okay. So that brings the capital structure theory to an end. Let's just stop here for the day. So we're ending our Sunday with this particular chapter. All the best for the upcoming exams, guys. Okay. Bye bye, guys. Take care. Yes.